While we believe that someday everything will tokenize, it is going to take us a while to get there. What we've tried to do at DTCC is really, we're trying to take 55 years of evolving the U.S. capital markets, one of the largest capital markets in the world, and we're really trying to digitize that in a matter of like 50 weeks.
Welcome to Tokenized, the show focused on stablecoins and the institutional adoption of tokenized real-world assets. My name's Simon Taylor. I'm your host for today, author at FinTech Brain Food and head of market dev over at Tempo. And there is no Kai today. He's actually taking some time off. Guy's had quite a big year. But don't worry, you'll hear his voice soon because we recorded our 2025 review, our 2026 predictions, and they'll be coming to you very soon. I'm joined for the whole show by two incredible guests. Making a return is Marieke Flament, who is an NED, investor, advisor, former CEO of the NEO Foundation, CEO of the Neobank Metal, and former CMO of Circle, possibly the most qualified guest we could have on the show. Marieke, thank you so much for being back with us. How are you?
Very good. Thank you so much for having me back. Really looking forward to our chat today.
And making a debut is the incredible Chuk Okpalugo, who is founder of Stablecoin Blueprint, now working at This Week in FinTech, hosting the incredible Money Code podcast. Please do go check that out. And if you follow Chuk at all on social, he creates some incredible stuff. Now, and formerly product at Paxos. How are you doing, Chuk?
I'm doing very well. Thanks for the kind words.
Yeah, you're welcome, man. You do good stuff. I'm going to give you your flowers. That's going to happen. And we're also joined by a special guest to help cover one of the biggest stories of the week. This is Nadine Chakar, who's global head of DTCC's digital assets. Nadine, how are you doing?
I'm doing great. Thank you for having me.
Thank you so much. You've got a big story. We're going to come to that in a second. But before we do, I just got to remind everybody that views and opinions of our contributors today are their own and might not reflect those of companies they represent. Please don't take anything we say as tax, legal, financial, or investment advice, and always do your own research, folks. And I'm happy to remind you that this podcast is sponsored by our friends at Centrifuge. Tokenized is also brought to you by our friends at Centrifuge. Through every crypto cycle, Centrifuge has been building, and today they are the market leader in tokenized real-world assets. Back in 2017, they were one of the first to mint a stablecoin backed by real-world assets with Maker. They're now launched an RWA lending capability with Aave, which is over $1 billion in total value locked. And Centrifuge works with major institutional partners to tokenize and distribute their funds. From treasuries to credit strategies, Centrifuge connects traditional finance to decentralized markets, creating new ways to access and put capital to work. Centrifuge is more than simply part of a tokenization wave. They've been kind of driving it in many, many ways. Whether you're an asset manager or a fintech exploring tokenization or a stablecoin allocator seeking high quality institutional yield, look no further than Centrifuge. All right, story number one from just about everywhere. The DTCC is now authorized to tokenize the top 1,000 US stocks. So, of course, the DTCC through the subsidiary DTC, that's lots of D's and T's and C's, this is essentially the people that hold and move the stocks, processing 3.7 quadrillion securities transactions annually, with custody of over $100 trillion in assets. When you buy an Apple stock through Fidelity, DTC is what actually clears and settles that trade at the last leg. This is not a synthetic derivative or an IOU. This is actual real-world assets, real obligations being tokenized. And this is in the same week that Securitize are launching their real, not synthetic stocks on chain. So, Nadine, we couldn't have a better guest to talk through this. Talk us through the journey to get to where you are today and what you're hoping for now that these stocks will increasingly be available as tokens.
So it's been an exciting week, but it's been years in the making. So we joined DTCC, myself, Dan Doney, and a whole bunch of us about 2 years ago when DTCC purchased the fintech that we were leading. It's named Securency. And Securency, actually the same platform, the same technology, was actually the backbone that allowed WisdomTree many years earlier to achieve its first SEC authorizations to launch some of the first tokenized money market mutual funds actually in the industry. So 2 years ago, actually last week was our 2-year anniversary when we joined DTCC, and we had been working on how do we extend what DTCC does into the DeFi world. That is really the vision that we have, is how do you bridge between TradFi and DeFi? And listen, there's a lot of people with very strong opinions of what that depositories won't be needed in the future, that we don't want anything that's centralized, all that good stuff. And what we actually tried to do was show them that there's actually value to have organizations like DTCC really help with that process. Now, what happens in 5 or 10 years, I don't know. My guess is it will continue to evolve and we'll do what we do a bit differently. But you needed somebody right now to be able to do tokenization in a way that continued to protect investor protections. I'm sorry, that's probably 2 protections in one sentence, not a good thing. Really extend it with all the legal rights and obligations that go with it. And what a depository does, which is really important, Simon, is we are also the good control location. When you have an issuer like Apple, let's assume they issue 1,000 shares. How do you make sure after the 1,000 shares get tokenized and those get tokenized and those get tokenized that there's still fundamentally 1,000 shares? And that's really what the depository does, among other things that we do. So extending that into the digital world, I think it's also important to acknowledge that our hypotheses, and I think you'll agree with that, is while we believe that someday everything will tokenize, it is going to take us a while to get there. What we've tried to do at DTCC is really we're trying to take 55 years of evolving the U.S. capital markets, or the largest capital markets in the world, and we're really trying to digitize that in a matter of like 50 weeks. Obviously, there's been a lot of work and foundational work that occurred before that, and I'll give you some stats here. It's like you said, we settle for $250 billion a year, which is true. I don't know if you guys know how many zeros are in a quadrillion. I had to Google that my first time. So you get anybody want to take and you can't Google it right now.
Is it 16?
You're close, 15. Right, or put $100 trillion on our platform. Like that was, we had grandiose ideas on how we can transform the markets, but not at the scale. So you need scale, you need resiliency, and there's no better institution that can enable all that. So it was a matter of like, how do we enable the market? How do we give participants and consumers choice? You can tokenize or you don't. You can continue to use the old ways or the new ways. But if you want to engage in the brand new world of DeFi and test your investment hypotheses, we wanted to give the market on-ramps and off-ramps that they could do that. And this week, the SEC agreed with that, and hence we commence our journey.
It's a big moment for sure, and I think it was Vlad Tenev of Robinhood said that tokenization would be the biggest thing to happen since dematerialization, and of course the DTCC itself really grew up in the ending of paper stock certificates and the forming of depositories. So now surely it gets to pass the torch to tokenization. But there was also this narrative at the moment of the amount of things where distribution of existing assets is really a leg up into tokenization. If you already have cash, if you already have customers, if you already have stocks, you're the right place to do it. But we have seen these synthetic wrapper products before, where it's an SPV or something else. Talk to me about why it's important that this is not a synthetic wrapper around the stock. The token really is the legal rights and obligations and claims to that stock.
At least it's important the way we view the market, right? Again, we look at our role in the market to ensure stability, to ensure that there's deep liquidity, and obviously investor protection. So the best way we could think of doing that was to extend, if you will, the offerings that we do in TradFi into DeFi, so in the digital space. We are creating digital twins, so you can actually move the assets on multiple wallets, depending on what your investment strategies and your risk tolerance are. We also wanted to make sure that by being able to ensure that it is a real good representation of that asset. Again, I go back to the good control location. Somebody's got to account for that. Somebody's got to ensure that there's governance. So I'm not saying the other models work or don't work. Honestly, where we're at right now in the marketplace, every single innovation is a step forward to get us to the place that we're all trying to get to go to. And I view the way we've decided to do it the hard way. For example, there's nothing harder in what we do. Is probably the less sexy thing that we do is corporate actions, right? Paying dividends, paying income, doing mergers. That is very hard to do on chain. And we've taken the past couple of years to be able to figure out how do you process it on chain, but there's also protection of the underlying participant, right? There's protection of data. So from a technology perspective, it is an amazing problem to solve. And this is where you see DTCC emerging into a true technology enabler and provider. So all the things that people think about centralized depositories, we would like to think that we sort of shattered that myth. And Simon, I don't know if you and your listeners may have looked at what we did earlier in April. We did something called the Great Collateral Experiment. Granted, no marketing people were hurt trying to name that experiment. But what we were able to show is the technology is no longer the problem, right? Like we've got good technology that works. We were able to show how you can combine crypto assets with traditional assets. We were able to show how you can move collateral at the speed of the network. We were able to show, God forbid there's another bankruptcy like Lehman, we could return the assets. We know where they are every single step of the minute. Every single minute of the day, we know exactly where these assets are. Should something bad happen, we can, and this is where we use a very proprietary methodology. It's called a compliance-aware token. So again, we're highly regulated. We need to make sure that I know who Simon is, that Simon is a good guy. Simon's use of funds are legit. And then you and I can then exchange our tokens 24/7, as long as I can recognize your wallet and move things around. So we were able to shatter this myth that depositories, we know our role in the future is going to change. I don't believe we're going to disappear. I think what we do and how we do it will change. And you're starting to see this evolution with the first steps that we're taking today.
Marieke, what are your thoughts, questions, comments?
Well, a lot. One, I think it's huge. So indeed, like Nadine, congrats. And it sounds like it's been quite a journey, and there is more to come. You know, when I saw that, I was like, oh, the Larry Fink vision is also coming too, right? We hear tokenization of financial markets, which on reflection, I remember, you know, when I was at Circle, like almost 10 years ago, Jeremy was also talking about tokenization of everything. Except 10 years ago, people thought you were crazy if you were saying that. And to me, this is like, now it's starting to really happen. And you have this very huge component of the infrastructure system that are doing that. So that's thought number one, which is like, we are getting on this realization of the journey. My thought number two was, I wonder what it would take in other geographies to get to the same level, right? And actually the realization that with DTCC, you have a unique, like humongous player, which basically can therefore also show the way to a much more fragmented market behind that for anything that's stock related. So I think that will definitely be charting the way forward in terms of what other continents and what other geographies might actually be doing. So I think a lot of eyes are going to be on that. And I mean, my third thought is more like, it's more technical, but I was wondering, because it's the beginning of the journey, but which chains are you going to use, or how is that all going to work? Because I think there's going to be a lot, and a lot of eyes looking into that, given the volumes and given the size of it. I think there's going to be a lot to look into that. But again, congrats. I think it's huge, and it's definitely getting into this tokenization of everything that we've been talking about for decades.
Thank you. And you're absolutely right. I mean, all our clients are global in nature, our participants. So while we're starting the journey in the US, and you notice these tokens, once you issue them and release them, they can move anywhere they want to move to, right? So they become global in nature, and we've taken great pains, if you will, to ensure that wherever jurisdictions they operate in, that they're compliant with the local rules and regulations. But again, we would advise all our participants and users of these tokens to get their own advice as we started this podcast. And you're absolutely right. On the chains, I think you saw yesterday, we announced the first chain that's out there, which is that we've partnered with, which is Canton. To your point, there is not one chain that's going to be able to handle the volumes that we're looking at. So by definition, we will be looking at other chains, but they need to satisfy requirements that are going to make our regulators comfortable that there's nothing funny happening behind the scenes. And I think you guys have seen the stories this week. So, we take great pain to ensure that from a legal and regulatory perspective, all these chains are above board. And what DTCC is working on is to, as we add these chains into our ecosystem, that we would have an orchestration layer that covers it, right? So if you tell me, all right, mint today on Canton, but tomorrow I need you to move it to Stellar or move it to SWI or wherever we want to go, Ethereum, will be able to do that while maintaining the appropriate records. So I think that's going to be super important, and that will be another phase, if you will, of where we'll head. Because yes, the headline today is we're going to tokenize everything. But in my head, it's like, okay, we did that, then what? Right? So we've got to give these tokens mobility, velocity, a purpose. That's where the collateral app chain comes in. This is where some of the orchestration layer comes in. And then working with our participants across the board to create more applications that would add value as we move down the chain.
Chuk, your thoughts?
Yeah, I think it's incredible, really, and I echo the congratulations. These are many years in the coming, and I remember when I was working at Paxos, one of the first things that we did, we were working, and you may remember, Nadine, we were working to build a clearing agency that would plug into the DTC and enable the immobilization and then clearing and settlement of securities, and then pass them back into the DTC when needed. And I think one thing that folks probably don't appreciate about what Securrency and now within DTCC is doing is this incredible innovation within such a large system that processes so much and has so many rules and regulations and processes that have been going on for decades to adhere to. And we mentioned at the beginning of the section that this is not a wrapper, it's not an SPV, it is the direct share. It's as close as you can in this current system, which is the security entitlement. And we're about to talk about another model, which is also the direct share, that's securitized. And, Securrency is securitized with the two kind of pioneers of the space, right? And they have a different set of constraints where there aren't the same set of rules and regulations. It is brand new, and they have to kind of operate in a way where, yes, the user can hold a token and be on the cap table of the customer, the customer here being the issuer, the company, but that's an opt-in, and there are a lot of constraints as to how that fits in with existing systems. Versus with the DTCC, everyone knows, all the participants know how that fits in. They know how to reconcile, they know what the equivalent movements are, and being able to do all that innovation within a world where everyone is already participating, the 100 trillion of asset is already sitting, I think puts you in a great position to move more of the kind of standard flows on chain. And so I think that's a unique point where I think both systems will need to coexist, that you don't get the 3.7 quadrillion of trade settlement without the efficiencies of clearing in a kind of centralized way. But you need to be able to add the tokenization in a world where the existing participants are working and all the rules and processes are well understood.
Indeed.
Yeah, I was going to say, Chuck, you're spot on, and a great debt of gratitude to the Paxos and Chad's vision earlier on, and also a massive shout out to Frank Lasella, the current CEO of DTCC, and the board, because when they did acquire Securency, they definitely took a leap of faith that this was going to happen. So their vision for the future actually panned out very nicely. And to your point, and I think I said it earlier, I think it's very early in the stage to determine if there is a right model or not. So that's why every model is a good step forward. But there's one thing that we need to make sure that we don't do, and we need to work together as an industry, is we can't fragment liquidity, right? Like our markets are the biggest in the world. They're the envy of the world because we've got very deep liquidity pools. So if you go back and take a look at the work we did with NASDAQ, and again, just like the chains, there'll be one of many exchanges, one of many pools that we will work with. So no matter what we do and what models we choose as an industry, there's only one cardinal rule here, maybe two. One is don't fragment liquidity, and two, make sure that ownership is accounted for and well governed. And I think everything else will eventually fall into place as technology gets better, our understanding gets better. And then there's one last piece, which is everybody's excited about this, but the state of readiness of the industry is still not where it needs to be. And I think 26 will be a good transition year, maybe spilling into 27. So we'll have inventory. It'll be available in Chakar model as well as opt-in. So we're not, we will need a participant to say, tokenize whatever stock that you have. And the methodology that we've used is they actually can tokenize from traditional into digital, and they can also request to go back from digital into traditional, and we'll give them their positions in both, so they'll get total and how they're broken out. So that will be critical. But what I'm more worried about, I'm somebody who spent my career, on the infrastructure side of the house. So looking at how this transition is going to occur from very traditional systems into this new brave world, converting from account-based systems into wallets, that is not, and that is something that still I think that on back offices are still grasping with, and we'll help on that journey.
It's non-trivial. Nadine, I think I'm echoing everybody. I want to say congratulations again. And we look forward to many more things to come from you. If people want to find out more about what you've been up to, or if they do want to opt in, maybe they are in the industry and, they're building a neobank and they're building a brokerage, or they're sort of clearing agent, and they want to look at this and if it can make a difference for them, where do they go to do that?
So we would love to hear from everybody, whether you're an advocate or not. So we'll talk to one and all. I would urge you to go to the DTCC.com website. We have a microsite there where we have the FAQs. We've got the NAL letter. We also have, if somebody would like to become a DTC participant, we'll walk you through all that. And if all fails, just come to me, and I'll be happy to assist. But the website is probably a good place to go. We've gone to a great length to put all that information, and we update it pretty much a couple of times a day.
Well, thank you very much, Nadine. We'll have you back on the show many times, I'm sure, to talk about it.
Thank you so much, Simon, and happy holidays to all. Thank you.
Congrats again.
Thank you. Bye for now.
Thank you. Congrats again.
Thank you.
Alrighty, guys. The next story this week was from just about everywhere. I don't know if you saw this one, Chuk and Marieke, but Visa are going to make stablecoin settlement available to US banks using USDC and Solana. Cross River and Lead Bank are the first to use it, and this means banks can now settle 7 days a week. And the head of growth products at Visa says, our banking partners are not only asking about us, they're preparing to use it. And Visa said their stablecoin settlement is already running at $3.5 billion annualized, and that compares to the previous quarter where I think they said it was $1 billion. So 3.5x is pretty good. And they also announced their stablecoin advisory practice. So Kai's been saying every big company needs a stablecoin strategy, and lo and behold, he goes and builds an advisory practice for himself. But Chuk, I'm going to come to you first on this. Like, how important is this move, and what difference does it make to banks and sort of behind the scenes? What's your take here?
My favorite part about this is that it's a domestic settlement use case. I think many people think about stablecoins as, okay, where do they fit? Domestic rails are pretty okay. cross-border. It's all cross-border. It's remittances, it's treasury, it's this. And this is a domestic use case. And when folks are looking at there's always so many Visa settlement diagrams on LinkedIn that you can find of money has to go from the issuing bank to the acquiring bank, but Visa facilitates who gets what and when, and through a kind of clearing and settlement process. And if you're the merchant, you get your funds in 3 days. And if you're the issuer, you have to manage your treasury and think through when you're going to settle, and you only have 5 days of the week to do so. And so there are benefits on all sides. Really, this is upgrading a core part of the kind of the settlement pipeline and plumbing for this network. And I think, in the future, even though we're at 3.5 billion, which is a small part of Visa's overall volumes, over time, the merchants will no longer be held hostage by the merchant acquirer. The funds should be getting there faster and faster as more and more stablecoins settlement is a greater percentage of the overall settlement that Visa does. So very excited to see, especially Lee Bank and Cross River being the kind of the early pioneers, being able to offer unique sponsor bank card issuance programs to their fintechs. And I think that will empower fintech companies to start to offer better use cases for their customers. And that should overall put more and more pressure on other card issuers and other acquirers to improve the offering. And so bit by bit, unfortunately, the 3.5 billion annualized number, we don't have a good number to compare it to. I think people know that Visa processes 17 trillion annually, but that's the authorized number. That gets multilaterally netted down to a much smaller number. We don't have a sense of what that is yet. Be curious to know, maybe if Kai isn't here, but it would be curious to know what percentage that 3.5 billion is of overall settlement, because I think that's going to rapidly encroach on that number over time.
Indeed. Marieke, your thoughts?
Yeah, I think Chuk, you nailed it. Like the fact that this is actually a domestic use case is actually really interesting because everybody out there is indeed talking about cross borders. I think that's a huge thing. The other thing to me, it's really like this is using stablecoin rails instead of fiat rails, and therefore this idea that now you have like a unique layer on which you can go back and forth and therefore go faster, and you could transpose that mechanism even in other geographies. Actually, you could say, let's say for example, for the African continent, you could have the same fiat, like you could have the same stablecoin rails, but that actually help do that between different countries. So I think that's actually also a very powerful concept, the way it can be designed. So that's one thing. And, bouncing back on what Nadine was saying, there's something really interesting with liquidity, because I also loved her last point, which was like, we cannot mess up liquidity because everything is going to be about liquidity. And we are indeed sometimes, I wonder, a bit in danger because we have so many different chains, even if it's the same asset that it's being bid on. And therefore, like, are we fragmenting things too much? And therefore, what are we doing to liquidity? But here, this use case is actually helping liquidity. And I think there is, and I don't know what the number is, but I think there's a huge amount of liquidity that's being trapped because it can't actually be released fast enough for all the smaller banks, for actually all the smaller merchants, that if they had it, their working capital would actually be better. And therefore, what they could offer to the end user would be better, and so on and so forth. So I think that's just the tip of the iceberg, which could be a very big unlock. And so yet still to be seen how much it plays out and how much it's going to be. But I think there's definitely a lot of potential. And indeed, like, it looks like, Visa is firing on all cylinders here. So yeah, looking forward to seeing what the other card issuers are going to do, because game on.
Indeed. Your boy Kai was on Bloomberg talking about this stuff, and he was in 4K, and I think the TV presenter was in 1080p. Like, I don't know what's going on there. It was an incredible video, but long may that continue. And I think, to your point, Marieke, it sort of pressures the rest of the industry to look at this alternative settlement mechanism. And whilst, yes, I fully agree, the domestic thing is what really stuck out to me about this. It does work across borders too. Like, sometimes you issue cards and a customer authorizes a payment, but then settling that through the correspondent banking network, that can be extremely slow and expensive. Even as a card issuer, like, that's quite painful to do. If customers walking around the world, on a tour of Latin America using their Visa card, then all of the different local banks that you have to settle through correspondent banking with as the card issuer in the United States, that can be tricky. So stablecoins, just Done. Much, much simpler. And then it becomes this rail above rails, this alternative settlement layer. And I think people are starting to get that now, which is a really good point. The couple of other stories that caught my eye on the stablecoin front whilst we're there, both SoFi and Coinbase launched stablecoin-as-a-service, this stablecoin issuance product. Chuk, your thoughts on both of these, like Coinbase coming into it, and SoFi specifically, because their setup's a little bit different.
Right. I think this is just another indication that stablecoin issuance is a commoditized product, and the issuers have to position themselves differently based on the types of customers. How regulated do they need to be? How large, how small, how programmable? There will be many, many stablecoins, as is becoming very clear. And I think, I counted about maybe 7 or 8 issuers who have come out in the last 6 months. What's interesting about SoFi is they are a OCC regulated bank. So it's they issued also SoFi USD. So it's the first time a national bank has done that. And I think their positioning will be, hey, if you are a bank or a bank-like institution, you can trust us because we understand you. And we understand the regulation. We understand what you need. We can speak your language. And the reserves are held at our accounts at the Fed. And so they kind of have the kind of end around CBDC, but it's private because essentially it's cash. There's no treasury. There's no run on the Fed, right? It's not like, you can look at the comments that folks have made about people having a run on stablecoins and potentially having liquidity issues on treasuries, even though treasuries are incredibly liquid. You can't have that argument with the Fed master account. And so I think SoFi's positioning is strong from that perspective because there are no other issuers who can credibly say that until the many issuers who have just received their OCC charter, if any of them get Fed master accounts as well, then they'll be able to do the same thing. But unclear when and how soon that will happen. And then for Coinbase is really interesting. I think I saw some confusion, backed by USDC and a basket of other stablecoins. How does that work? But folks may forget that Coinbase, because of their relationship with Circle, earn 100% of the yield from Circle's stablecoin, and they get a proportion of the yield that's sitting outside of the Coinbase platform. So 100% of what they sit on and a percentage of what's out there. And so therefore they can utilize that in their own rewards. But not only that, that's what most, stablecoin issuers will do. The underlying asset is a token. So their reserve management will actually be quite efficient because it's completely on-chain. They don't need to actually manage treasuries. And some folks are using tokenized treasuries, but if you work with Biddle, they have minimum investment requirements. So Coinbase can do
and 50
exactly
bits to move it. It's very expensive.
So Coinbase now essentially has one of the most efficient reserve management processes because they can just use USDC. Not only that, and they didn't say this, but I imagine they'll try to do this. They can make their white label issued stablecoins interoperable with USDC on chain, which is another benefit because, as we know, in DeFi and in most Western use cases, USDC has the most liquidity. Now, Tether has more liquidity elsewhere in foreign exchanges and cross-border payments, and USDC is catching up, and they're working very hard there. But the ability to be seamlessly interoperable on an on-chain way is quite a good draw. So Coinbase actually are quite competitive, and they also have their extensive on-ramp and off-ramp network. Plus, their Coinbase developer platform has wallet tech and so on. So they're actually quite a venerable competitor into this many-horse race.
Indeed, and orchestration may be coming next. It's the probably the one piece missing, and there were rumors of them potentially acquiring BVNK or others to try and nail that piece. Marieke, any thoughts on these two stories? I know they've sort of come up in the last 24 hours, and you might not have had a chance to look at them.
No, but I think to me what's really puzzling is, and Chak, I agree with you, there's probably going to be many stablecoins out there. But, how orchestration, liquidity, all of that, I'm just how is that all going to work? So I think that's still actually to be solved because it's not just about having the possibility to launch a stablecoin, then you need like a powerful distribution network. You need to have a reason to really do that, and in a way to do that pretty better than USDC or USDT, right? So I think it will be really interesting to see what the pickup is of those. Indeed, it's a signal that, issuing now is completely commoditized. I really like the point that Coinbase is pretty better suited to do that, because they will probably be able to offer some of that interoperability. Otherwise, if you don't have that, I think you're really going to struggle. Like, look, how many USD-backed stablecoins there are today? Like over 200. And how many are real? Like 2 are real, right? So why? Do we need more? I don't know. Do we need more in other currencies? I think, other currencies, other countries, other geos are starting to wake up. And I think we're definitely going to see that. And there's a playbook to actually make that, right? The making of it is not that complex. Although by geo, like how you back it is slightly different. But yeah, to me, when I hear that, I really, my mind goes into what does a world with like multi-thousands or tens of thousands of those stablecoin look like? And therefore, what are the missing interoperability? And also like, how is liquidity really going to work so that it doesn't mess it up and actually makes it worse than it is today?
Absolutely. I think there'll be 1,000 or more than 1,000 stablecoins, but many of them will stay within their walled gardens. The incentive for a financial platform or a platform that handles money, which can be so many different platforms, can be consumer, marketplace, gaming, and so on, e-commerce. To control your own dollar is very large. From treasury to the way that your internal customers, maybe the buyers, maybe the sellers, maybe it's a multi-sided marketplace, interact with each other is very, very strong. And so I think there's going to be lots of branded stablecoins, and they're mostly 95%, 99% going to be utilized on the platform which issued them. And that will be a financially, economically positive move by these firms. And then the question will then be, will any of these break out of these walled gardens into something that's more into DeFi or cross-platform? I think that is a very small number. I think a few might. And the ones that I would have my eye on are if the large social media companies or very, very large consumer brands manage to get a branded stablecoin in the hands of enough people, then they can start to go to merchants and merchant acquiring network and say, actually, if you accept this token, maybe there's some incentives in there. And I think, one to watch out for is Cash App, who, only a couple of weeks ago released, shared that they were going to support stablecoins. They didn't say anything about a branded stablecoin yet, but that's the kind of platform that has such a strong consumer dominance, 55 million individuals, that if they did, and you're a merchant or you're a developer building for that user, you would accept that. And that's the way that it would break out of that walled garden.
And they also have a lot of terminals. I think what's interesting as well is when you scratch beneath the surface of a lot of these branded stablecoins, there's about 4 or 5 companies at the bottom of all of it. And if they replicate what Circle has with CCTP, the ability to go across multiple chains and some of the orchestration tools, then really everything sort of does ultimately go back to those and should become quite instantly swappable and quite liquid. So to the consumer, I might have all of my branded stablecoins and I go to spend them, and then behind the scenes, that's getting swapped for USDC, which is then getting cleared, right? Like, programmable money has benefits, people. All right, I need to pause here while we hear from our sponsors, and we'll be right back. This episode, if it isn't already obvious, is sponsored by our friends at Visa, the leader in digital payments. Visa's Tokenized Asset Platform, or VTAP, uses smart contracts and cryptography to help banks bring fiat currencies on-chain, whether it's launching a stablecoin or deposit tokens or something else. VTAP allows financial institutions to issue fiat-backed tokens, improving financial efficiency and enabling programmable finance. Check out the links in this episode's description to express your interest in VTAP. This episode is sponsored by Stripe. Here's the thing. Selling digital goods globally is still far from easy. Many of the people around the world that want your product don't have an easy way to pay you. They simply don't have access to cards or a bank account. Stablecoin payments change this. They're the first truly global payment method that you can use from anywhere. That's why, for any business with global growth ambitions, accepting stablecoin payments is table stakes. With Stripe, doing so is as easy as flipping a switch. From big names like Shopify to fast-growing names like Shadeform, businesses everywhere trust Stripe to accept stablecoin payments from everyone, everywhere. See what's possible at stripe.com/crypto. Thank you very much to our sponsors. The Wall Street Journal had a piece about JP Morgan launching their tokenized money market fund on Ethereum. They're going to seed the fund with $100 million, and it's open to outside investors. It's called the My Onchain Net Yield Fund, or the ticker MONY. Money. No notes. Chef's kiss. Just utterly beautiful. It's going to only be available to qualified institutions, and the head of global liquidity at JPM said there is a massive amount of interest from clients around tokenization. Interesting to me, Chuk, that they're sort of getting into that BlackRock Biddle space, right, of tokenized money market funds, but they've been doing Connexus for a while. They've been doing cross-border 24/7 tokenization. The treasury management use case here could be quite good for their walled garden, but it's going to be open to outside investors. But that's obviously who's investing in the money market fund. What are your thoughts on this? What's your takeaway?
I think they had to get into this business. They, like stablecoins, I think tokenized treasuries or treasury-style products, money market funds being one of them, is going to be a kind of a crucial part of the toolkit if you are a financial services provider. And JP Morgan, of course, the largest in the world, they need to have this product. It enables their financial institution customers, the institutional clients, to be able to go in and out of a yield-bearing asset instantly. No waiting for a day, no book transfers, and that powers just much more efficient capital management on the investing side. Now there are corporate treasury use cases here. Now there's only so many corporates that would classify as qualified institutions, but this is just a starting point. And so I think being able to just move in and out for those two customers, and also potentially serve as a backing for stablecoin issuers. I think we mentioned earlier Coinbase having a tokenized backing with USDC. They can do the same with JP Morgan. And I think when I looked at the release, the minimum transaction size is 1 million instead of 5. And so already starting to be a little bit more user-friendly than Biddle. But there's already a long list of tokenized funds. And I think each financial institution will have its tokenized deposit, its stablecoin, if they so choose, and their tokenized fund, and they'll work very well together. It makes sense. They may as well already utilize the distribution and the customers that they have and offer them their same asset management products.
I think that I just want to underline something you said there, that every institution will have their own tokenized deposit, stablecoin, and potentially money market fund if they're going to be a financial institution in tokenized markets. I think that double underline exclamation point is such a key thing you just said there, Chuk. Marieke, your thoughts on this and your thoughts on the middle class of stablecoin issuers, the middle class of people in tokenized markets that can't just buy in for 5 million. Are we seeing competition at last? And is JP Morgan doing it as well?
Yeah, well, I think it's definitely, again, all of that is in the same thesis around, Larry Fink, his piece in The Economist. I was like, brilliant, right? This is it. Like, just another live example of what it means to tokenize financial markets. Interesting to see also competition heat up, right? So you guys mentioned BlackRock. Yeah, I think Franklin Templeton, Fidelity, they're all trying to have some sort of product. So I think we're also going to start seeing competition in terms of ticket size, competition in terms of fees, and therefore those products are going to become more and more appealing and therefore better and better, right? And until the day when it gets into, more Robinhood type and all those type of products, which is total democratization of how you can invest in a way that is actually tokenized. And I think that's the real power, and that's actually the real revolution that we're going to see, which is you can do not just like very, very large tickets with those instruments. Because the idea ultimately also with anything that's tokenized, you should be able to do micro transactions because you can actually, itemize it to the level of subfraction that you want. So I think again, all of that in the same movements, in the same block. I think it's very interesting to see that the big players are getting in, that they have to propose some sort of product. And to your point, like the middle layer, the people who are in between, I think it's coming. It's a matter of time because when we see like more and more of this going, at some point, how many very large players do you have that you can serve? They're all going to have a supplier, but then you can actually start going down further line and therefore having smaller size tickets.
Well, and if everyone's going to be a stablecoin issuer in the future, or there are going to be more stablecoins from more financial institutions, there are going to be more tokens coming along, then this is currently quite a small market for JP Morgan, but it looks like they're placing a bet that it's going to get bigger. And it is an incumbent that is quite happy to move this way. JP Morgan Connexus is now central to their entire payments franchise. And you've got to remember, the payments franchise has been the driver of the stock price growth for JP Morgan for quite some time. It's the jewel in their crown, as it were. That's been driving so much of their growth. I think it's 35% of their earnings. This is a massive, massive bet on tokenization that is probably they've not given credit for. And so people look at the Connexus volumes historically being, sort of $1 trillion or so, and that's meaningful. They're a very big bank, but it's a fraction of what they do in a day. It's still very small compared to something. People forget just how big JP Morgan is. Like they're just enormous. And so them bringing this is really meaningful, but there may be other areas that grow. And I think one of the things that will help things grow is, of course, the FDIC proposed a stablecoin application framework rule as it moved forward with Genius. So the board of directors approved and noticed a proposed rulemaking that sets out an application process for financial institutions that are covered by the FDIC to issue payment stablecoins through a subsidiary. The counsel, Nicholas Simmons, said that the application would need to scope out proposed activities, provide a description of the subsidiary's ownership and control structure, and include an engagement letter with accounting. They also get into some quite interesting redemption mechanics and notice periods and all of the kind of things that if you were the FDIC, you'd want to be able to see so that you could unwind something like this in a bank run scenario, which is sort of the FDIC's job. I'm impressed by the pace of this, Marieke. And do you think you can just give me some comparison here on how different this kind of pace and momentum is from where we sit in Europe and some of the things you see around the world?
Yeah, definitely. That's also what I was thinking, right? Like for this move to happen, it's definitely like very promising because if I get that right, there's actually over 4,000 banks that are overseen by the FDIC. So this is a significant move in terms also of the oversight of it. However, the one thing I was pondering upon is like, it's also still like the complexity of the US system, because my understanding is that although you have that now with the FDIC, you'll need that also with the OCC. So there's going to be like different translation, and therefore depending on where you fall within, like who's your overseen and the regulator, you're going to have to do that. We don't have that in Europe. There are many things that are complex, but we don't have that. So, I think that might be one thing where all things granted together, MiCA might be slightly, a bit more, I would say, dare I say, simple in a way, because you go to the country where you actually are supposed to be, and therefore from that country you can actually then passport. So it's a bit cleaner, and you don't have all this different hierarchy. So yeah, that's those were the thoughts I had when I was reading into that. Super keen to hear Chuk and you, Simon. Like, what do you make of it? But am I right in thinking actually there's several layers of OCC and others that will basically need to fall in line with to also apply that?
Yeah, I think that's the part that I found interesting as well. They've kind of started the gun on the application framework, and the OCC, there's the OCC and the Fed. If you look at the full kind of range, and also one more for for credit unions. So there's 3 more entities that need to make rules. However, in order to prevent kind of regular arbitrage and make things simple and easy to understand, there will likely be some alignment. I'm sure the regulators are all speaking amongst each other. But in one way, by being out first, the banks and savings entities who have the FDIC as their primary regulator now have this clarity and can start thinking and start planning. Now, obviously, if you have a line in at the OCC, you're probably already starting to think about this stuff as well. But it's nice to have a kind of very clear public set of rules. There will be kind of 60 days of kind of comments, and then we're off. And we've been waiting for rulemaking around Genius for, it's going to take some time, but it's very encouraging to see this come out so fast.
Indeed. And that was what I was about to say, Chuk, is that these regulators tend to work quite closely together at the federal level. The Genius Act compliant permitted payment stablecoin issuers that are not FDIC insured would have similar, almost equivalent sets of rules coming out of the OCC, who would be their primary regulator in an unwind scenario. So interesting to see the OCC maybe next to move along with the Fed. There will be rules coming from all of them, but the pace of change here is really, really fascinating. And, one of the big criticisms, I think, historically of stablecoins has been, what about redemption risk? It's all IOUs after all, isn't it? And this is kind of saying, well, yeah, this is how we control that risk, and this is how we'll deal with liquidity mismatches. And it really is, given the speed in which this has happened, surprisingly, incredibly robust if you read the whole framework. So I'm the public servants don't always get their flowers and a shout out, but shout out to the public servants that are trying to pull all of this together, because they've been sprinting to get this out the door, I'm pretty sure. And not all of them are politically motivated. I think a lot of them are just trying to prevent another Silicon Valley Link and trying to make sure that things don't go wrong for consumers. And very rarely do we pull one out for the regulators trying to do the right thing. What I think is interesting observing this from the UK is how the optics are so different to what the UK has done, where the Bank of England, what the headlines pick up is a limit on the amount that an individual can hold personally. And whilst there were some sensible concessions on what your collateral needed to look like and what your backing assets could be for a local stablecoin. And it now looks like the FCA is going to be regulating a lot of those stablecoin issuers that are non-systemic, and that we will get some real forward momentum, that we do now have draft legislation for a stablecoin framework. It looks like it's going to be in the King's Speech and coming very, very soon. Those are all exciting developments, but those don't dominate the news cycle because of that one thing that was kind of done wrong, and this general sense of slowness, even though actually I think the facts on the ground are people are working quite hard to get things done. So I think something about the pace since the Genius Act in the US has really concentrated minds. Chuk, there's a couple of stories we didn't have time to cover, and I want to ask you about one of them in particular, which is PayPal launching PYUSD savings vault on Spark. You mentioned Cash App earlier. I don't know if you saw this savings vault that PayPal has done. Help me understand where savings vaults and PYUSD fit into the overall PayPal potential Venmo strategy, and how all of that fits together.
Yeah, so I'm not sure about the Venmo strategy, but in general, there are multiple vaults across DeFi, and essentially they are set up by either curators or by kind of other entities for folks to go either borrow and lend and so on, and therefore there's a return that one can get. I go deposit my stablecoin, in this case PYUSD, and I earn a return based on what that specific vault is doing. And I think what's super interesting about utilizing DeFi to create earning vaults, almost like you save in an account, it's almost like a savings account, you're essentially getting around the kind of stablecoins can't pay yield or stablecoins shouldn't pay yield argument by saying, well, stablecoins are also really easily transferable. And so if I can do the DeFi mullet, which is I have a regular Web2 customer facing app, and in this case, it could be Venmo and you mentioned Cash App as well. You have a user who goes from money in an account, could be a stablecoin, to pressing a button and saying, now I'm earning 4% or 6% or 9%, depending on what that is. And you have the Aave app, and you have Coinbase, who enables the customers to lend into a Bitcoin lending pool. All these different things are turning the game around on what it means to save and what it means to invest. And so I think by giving your stablecoin this kind of utility, you're saying to users, hey, yes, you can use it for holding, yes, sending and transferring and using it to pay for things. But whilst it's sitting in your account, yes, putting it in your quote unquote savings account is a vault, which earns interest. And so I think that is it's not a loophole. It's just a financial product.
It's just a different product. It's not
a
loophole.
That people
it is
forget
just
about.
A meaningfully different product.
Yes.
And I think that is very different to some of the rewards, the marketing rewards that you see in other corners. But I imagine every neobank and every non-bank would want to do this, because if you are valued primarily as a payments business, take a Chime, a Revolut, whomever, then how much do you want to get into balance sheet lending and be valued as a lender? Like, it's a different multiple. Whereas this, you're not necessarily a lender, but your customers have the benefits of being able to borrow or being able to earn. And these vaults just look like private credit funds, but they're way less complex private credit funds, because a curator is somebody who's put together a strategy, and then an individual has put their cash into this vault that's essentially following this software strategy. And that's a really interesting model that I think people have to get their heads around, because then you can ask sensible questions about what's the risk of that to the consumer and who's responsible for dealing with those risks and what disclosures do we need. But unless you understand what it is, it's very, very difficult.
Can I add on that, Simon? Because to me, that's exactly the example of going back to narrow banking. And that's the power of stablecoins, which is actually stablecoins now put in the hands of people, and you can choose with a bunch of different DeFi protocols where you place that. And so it could flip completely on its head the model where we're used today, which is like, I have a bank account, I actually put my money there, and then it's almost from that bank account that I need to find my strategies. And here actually I have stable coins, and I can choose like a bunch of different protocols that could be anywhere and everywhere. And that's how I decide to actually invest my money. And that's this narrow banking concept that stable coins are just creating. And therefore you could imagine banks are not banks anymore. It's narrow banks. And then actually all the other services are done in DeFi. And that's very powerful. I don't know how long it will take, but that's the...
It could take 50 or 100 years, but JP Morgan launching a money market fund is certainly an interesting development, right? And you've got to be hedged. You've got to be trying all the things. Well, look, thank you for indulging me on a couple of the extra stories we had this week, because I thought they were fascinating. And that does about put us out of time. So I want to thank everybody for watching and listening, as always. I'm going to do the annoying host thing and ask you to click likes and subscribes and all of those things, and please spam all of your friends to check out this show, because it really does help us and it helps us grow. I want to thank Chuk for joining us, being a debutant and being incredible as always. Where can people find out more about you and the many things you are doing these days?
Thank you, Simon. You can find me at my website, chuk.xyz. That's CHUK. You'll find links to X, LinkedIn, Stablecoin Blueprint, and MoneyCode.
And Marieke, how about you?
You can find me on LinkedIn, and you can read my newsletter, which is called Currency of Power, because the moment we live is very important, and there is definitely an unspoken Bretton Woods thanks to everything we've been talking about here.
Great name.
Yeah, somebody's going to formalize it. Yeah, great name, isn't it? And I did finally read the Barrels to Byte.
Barrels to Byte, yeah.
Yeah, where the GPU dollar is the new petrodollar, and stable coins are what's making that happen. I thought it was a fascinating piece. You'll find me at SY Taylor or at fintechbrainfood.com, and of course at tempo.xyz, noodling away on some of the blogs there, trying to make that documentation a little bit better every single day. If you haven't already, please do check out our phenomenal guests, and we will catch you soon.